Good morning and welcome to the Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Thursday, August the 13th, 2026, and we've got a packed show. The AI trade is showing some significant cracks after a split session on Wednesday. Applied Materials reports after the bell tonight, and PPI drops at 8:30 this morning. Let's get right into it. Lizzie, futures are flat to marginally higher this morning, but yesterday's session was anything but uniform. What's the headline story from Wednesday's trading?
Morning, Robert. The headline is that the AI trade is bifurcating in a meaningful way. Pure-play infrastructure names like CoreWeave, Nebius, and Supermicro had enormous sessions on strong earnings, while Cisco fell about 6% after hours, despite reporting solid revenue of $17.25 billion and EPS of still 9070s, and Cerebras cratered 16% even after raising guidance. The market is clearly separating winners from names where the valuation has simply run too far ahead of even good results.
That split between the pure-play AI names surging and established tech getting punished on strong prints. What does that tell us about where we are in this trade?
It tells us the bar for established names has become extraordinarily high after massive year-to-date runs. Cisco is up over 60% this year, so the stock was priced for perfection, and anything short of a blowout becomes a sell the news event. Meanwhile, the newer pure-play AI infrastructure names still have room to surprise because expectations haven't fully caught up with the growth story, though that gap is closing fast and the risk of the same treatment is rising for those names too.
And then you've got Michael Burry disclosing short positions against Nebius, Micron, Oracle, and the SOX-X semiconductor ETF. How seriously should traders take that as a signal?
Traders should take it seriously as a contrarian data point, but not as a precise timing signal, because Burry is famously early and can be wrong for extended periods before being right. His short disclosures reflect positioning, not an immediate catalyst. What it does accomplish is injecting genuine skepticism into what has been an extremely crowded consensus trade, and when you combine that with the earnings reactions we saw Wednesday night, it reinforces that this AI theme is mature enough that the easy money has likely already been made.
Applied Materials reports after the bell tonight with consensus around £3.39 an ounce, EPS on about $9 billion in revenue. Given what happened to Cisco despite a very strong print, how is the bar set for Amity going in?
The bar is high, but the setup is a little different from Cisco. AMAT is a semiconductor equipment maker that benefits directly from AI-driven chip demand at the foundry level, and last quarter they delivered EPS of $2.86 against an estimate of $2.69, so they have a solid track record of beating cleanly. The risk is that any cautious forward guidance on capex timing from customers could pressure shares, even if the headline beat is solid. So guidance language tonight will matter at least as much as the actual numbers. On the broader technical picture, the S&P 500 and SPY are both sitting in neutral territory right now. Momentum is still positive, and we're not yet in overbought territory. But there's no strong directional conviction in either direction, so the technicals aren't giving traders a clear edge heading into this print.
The business services sector is up 20.5% over 6 months, outpacing the S&P by nearly 9 points. Names like Flex, Korn Ferry and Genpact are being flagged as interesting, while Lumen and Connection are ones to avoid. What stands out to you?
Genpact stands out most on the positive side because it's trading at just 8x forward PE with 11% annual EPS growth, driven by buybacks and strong free cash flow. That's a genuinely compelling valuation in an environment where mega cap tech multiples are stretched. On the names to avoid, the biggest red flag is revenue decline paired with shrinking operating profit. Lumen has posted a 10.2% annual revenue decline over 5 years with deteriorating EPS, and at 5.6 forward EV/EBITDA, it looks optically cheap until you realise you're buying a structurally shrinking business. Connection is similar, 2.3% annual revenue growth and poor free cash flow at 19.4x forward. PE is not a value situation, it's a value trap. And the wide analyst price target dispersion we're seeing on names like Nvidia and Microsoft right now is a useful reminder that when the street disagrees sharply on a stock's fair value, position sizing should reflect that uncertainty rather than false conviction.
Steve, the main macro event of the morning is PPI dropping at 8:30 ET alongside jobless claims. Walk us through what you're watching.
The PPI is the headliner this morning, and it matters because Wednesday's CPI came in essentially in line with expectations, with headline inflation at 3% year over year and core at 2% year over year. That print already nudged the probability of a September Fed rate hike down to around 40% from 54% just a week ago. If today's wholesale inflation data comes in soft or in line, that further reduces the case for another hike and keeps Treasury yields under pressure, which is broadly supportive for equities. A hotter-than-expected PPI read would complicate that narrative and could push September hike odds back higher, which is precisely where the market risk sits this morning.
And jobless claims are also out this morning. The forecast is 202,000 against last week's 199,000. Is the labour market still resilient enough to keep that September rate hike debate alive?
Last week's actual print of 199,000 came in better than the 202,000 forecast, and the 4-week trend has been remarkably resilient throughout this stretch, so the labor market is clearly not flashing any warning signals at this stage. A print near or below 200,000 again today would reinforce that the labor market remains tight enough to keep the Fed's inflation-fighting credibility intact, and that two-sided pressure of a resilient labor market combined with still elevated inflation is exactly what keeps the September rate decision genuinely live rather than a foregone conclusion.
And what's on the radar for tomorrow?
Tomorrow brings retail sales for July out at 8:30 in the morning, and while no consensus forecast has been published yet, the context matters significantly. Consumer confidence for July came in at 50.2, beating the 54 estimate and improving meaningfully from the prior reading of 49.5, but the August forecast is already pulling back slightly to 54.5, suggesting some softening in household sentiment is underway. If retail sales disappoint, particularly in the control group that feeds directly into GDP calculations, it would raise real questions about whether the consumer is beginning to pull back heading into September. And given that we're entering what is historically a seasonally weak stretch for equities, a weak retail print combined with any Fed hawkishness would be a meaningful headwind for the growth narrative going into year-end.
Lizzie, over to crypto. Bitcoin briefly popped above $64,000 on the CPI print, but couldn't hold it, and the technical picture is neutral across BTC, ETH, and Sol. What's the missing catalyst keeping crypto from following equities higher?
The core problem is that crypto is waiting for a catalyst that equities don't need right now. Stocks can rally on inline inflation because the Fed pause narrative is sufficient, but Bitcoin needs something new and specific, like meaningful regulatory progress, sustained ETF inflows, or real platform-driven adoption to break out of this range. Technically, BTC is just under $63,600, Ethereum is around $1,780, and Solana is near $75.60. And across all three, the momentum indicators are essentially flat. No meaningful buying or selling pressure is dominating. The bias is neutral on all three, and the picture won't change until a genuine catalyst arrives to tip the scales.
Kraken just launched 20x leverage on spot Bitcoin. A 5% adverse move wipes out the position entirely. And separately, Hyperliquid is up 128% year-to-date, while Bitcoin is down 28%. What's your read on both of those stories?
On the leverage product, it's mostly creating landmines for retail traders because Bitcoin's normal intraday volatility can easily produce 5% swings without any news event at all, meaning a correctly directional trader can still be fully liquidated before the move plays out. And with Bitwise cutting 14% of its workforce this week, the environment is already pressuring established crypto firms, let alone individual traders taking on maximum leverage. On Hego, the outperformance is driven by genuine platform growth, record trading volume, real revenue generation, and a deflationary burn mechanism, tied to actual usage rather than macro expectations, which makes it fundamentally different from Bitcoin and XRP right now. Bitcoin is down 28% year-to-date, partly due to significant ETF outflows in May and June. XRP shed nearly 46% when the Clarity Act stalled in the Senate. And Hype's organic revenue model gives it a much cleaner fundamental story than those macro-dependent assets.
That wraps up today's Morning Bell. Remember, this is not investment advice. Do your own research. And don't forget to subscribe so you never miss a morning. See you tomorrow.